Hello, everyone. Thank you so much for joining us today for our first quarter webinar for tax planning. My name is Jeremy Kronemeyer. I'm the operations manager here for Wickham Financial Group. And I also, for our presenters, we have Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and John Dickson, who's a CPA with Hensler CPAs and Advisors. Graham, I'm going to let you take it away.
Yeah, thank you, Jeremy, and thanks for everyone really jumping on the call and continuing the overall theme that we have as a culture here. And if you've been a client of ours or you're just new to joining the webinars, we try to address 5 steps to wealth management, at least considerations of. That might be retirement planning, it might be investment planning, tax strategies, tax planning, if you might, risk management strategies, all the way over to estate planning. So when we're looking at these quarterly webinars, we're trying to bring different individual, a part of our team directly in-house, or the partners we work with, like John and his team over at Hensler, the experts, if you might, to address each one of those super important areas that we all need to be mindful of in all aspects of our financial lives, as we often say, through all stages of your financial lives. So let me go ahead and kind of jump in a little bit further. And John, I'll let you kind of take it away. But one thing I did want to be mindful of as we kind of go through the information is maybe my first question right off the bat would be, how important is it to be mindful of when we're talking about individual situation here outside of your business, because I know that'll be the next part of the webinar, is how important is it to position assets efficiently in your taxable accounts? If you just want to take a second before you jump in with your deep dive on the rest of the topics.
Yeah, well, I think it's very important. It's something that's a little different that we actually look at things like that to make sure we're being tax efficient. You know, when we're looking at clients' tax returns and looking at their different buckets of income and where that stuff, and working with the wealth management advisors to make sure, you know, if they've got fixed income, it's in a taxable account. You know, if they've got munis, it doesn't make sense to have munis in a tax deferred account. So just making sure all those different pieces work together. But working with a lot of wealth management clients, we're always thinking about the after tax net worth. You know, it's not just looking at tax, it's not just looking at your wealth, it's looking at an after-tax net worth. So, these are some of the tools that we use to maximize that. Some of these things that we're listing here, there's going to be a lot of information on these slides. I'm just going to hit some of the highlights, but, working with advisors, these are some of the things that we look to try to maximize clients' after-tax net worth. So if we want to just go to the first one, IRA contributions. Yeah, I think most people are familiar with IRAs, so I won't spend that much time on this, but there's deductible IRA contributions, non-deductible, as well as Roth contributions. But, I think a great planning opportunity for clients are the backdoor conversions, so where if your income's too high to make a contribution to a Roth, you make a contribution, a non-deductible contribution to an IRA, and then you immediately convert that Roth. So again, we're looking at those different buckets: your taxable accounts, your tax deferred accounts, and your tax never accounts. And just like I'm sure you guys talk about all the time, diversifying your investments, we want to diversify our tax buckets too. So,
right. Let me add one additional comment to that. When you're talking about funding an IRA, basically, and immediately converting that over to a Roth, we throw out a phrase like backdoor Roth. Is that a common practice when your income level is so high and you can't make that contribution or the deduction in that contribution into a Roth if your income's too high?
It is. I say, it's, again, some people want to hit grand slams, home runs, but it's really all these singles and doubles that really add up over a number of years. I mean, you think about, a $7,000 contribution, is that really going to move the needle? But, if you look at over a long period of time, what you can accumulate in a Roth, whereas your income might be too high to make direct contributions, looking to the future, your after-tax net worth in this Roth is going to be so much more valuable. So I think it is a lot more prevalent nowadays, where incomes have come up and those thresholds really, for a joint family, especially in Metro Atlanta, two working families, you might be phased out of doing Roth conversions doing the Roth contributions. So this back door allows them to grow that wealth.
Right. I often say sometimes it's about the short-term pain for the long-term gain when you're thinking about tax planning.
Exactly. And the next one we've got is HSA contributions. And again, these have become more popular with the cost of healthcare. You find that especially younger folks who don't want to pay the premiums for these high cost plans will do the high deductible plans, keep their premiums lower. Well, they also can contribute to an HSA, and this allows a tax deduction for these contributions. And similar to a Roth, these accounts can grow tax free. They can only be used for medical, but those medical expenses can be incurred at any point. So, for example, if you put your $8,550 contribution in, you leave it in this HSA and it grows. Next year, it's worth $10,000. You could go back and claim the medical expenses you had this year and take those distributions. Although what we see is most clients just let it grow tax-free because it's kind of self-insuring for future long-term care expenses. So you can always go back and claim prior year expenses to take distributions. But again, having that bucket of tax never, that can grow tax-free is a powerful component, especially with costs of healthcare always rising. So,
yeah, great point.
Next is 529 contributions. Being in Georgia, we've got great 529 plans that people can participate in. You can use it for elementary school kids, high school, and then also private school, capped at $10,000. And then also once postgraduate, you've got the ability to pull out more money for college. I think a good planning opportunity, people always are concerned usually about overfunding these. There's been new tax regulations that now allow you to pull out $35,000 and convert to Roths. So as long as the account's been open for 15 years, you can now start converting up to $35,000 for the plan to Roth. Now it is capped to your annual limit. So, if you find yourself in a lower income and you can contribute to the Roth, instead of taking money out of your checking account to contribute, you can take money out of your 529 plan and contribute it. So it's still limited to the annual contribution, but now you can use those funds up to $35,000 to convert. Of course, you can always change the beneficiaries and continue to use those for education purposes.
But that would apply, changing the beneficiaries and where it would apply from a tax-free standpoint if it's used for qualified education and it's immediate family, correct?
Right. Yeah. I mean, you could have a grandchild, you set it up originally for your kids. You don't end up using it all. Well, in taking the distribution and paying penalties, which you could do, you could take the distribution, pay the penalties and the taxes, and just use that money. Or you can just keep it, let it grow. And then once you have grandkids, you can change the beneficiary to the grandkids and then use it for your grandkids' education. So,
kind of going back to your original statement on the 529s, going into a Roth 15 years, is the $35,000 the max that they could convert over to a Roth if they named themselves the benefactor?
Correct. So you would only be able to take, for any benefactor. So for the 529 plan, you could only convert up to $35,000 to Roth IRAs. So it's a cap for that plan. So, I mean, I guess you could, if your child, if you funded 35,000 conversions for your child's IRA, and again, they have to qualify it. So if they have earned income to be able to contribute to a Roth, instead of taking money out of your pocket, you just take it out of the 529, convert it to their Roth. So they're funding their contributions for the year through the 529 plan. But if you did 35,000 for that beneficiary and then you switch beneficiaries, then you wouldn't be able to fund conversions for that new beneficiary.
Okay, thank you.
Next, we got the Georgia retirement exclusion. So for anyone in Georgia, 62 to 64, you can actually exclude up to 35,000 of income, 4,000 of that being earned. And then if 65 and older, then you can convert up to, or then you can exclude 65,000. So this comes into play sometimes from a planning strategy as far as the owners on the account. Sometimes we'll have taxpayers that the brokerage account or the investment accounts in one person's name. Well, if they're both over 65, you're missing out on that exclusion by just having those assets in one person's name. So sometimes from a tax planning strategy standpoint, we're looking at those ownership of assets as well. Obviously, there's estate issues and other things that come in, but these are planning opportunities that we like to point out to clients. And some people, you don't just make decisions on taxes, but it needs to be part of the discussion. So it's just something else some people might not be aware of. Now in Georgia, we've got a lot of different opportunities for tax credits, and tax credits are really benefits for individuals, but also a way to funnel your tax dollars to something specific. So in Georgia, they've had the rural hospital credit for a while. So that's, and Graham, I know you're familiar with this one, but this is where you contribute to a hospital and you actually get a credit for it. So instead of writing a check to the Georgia Department of Revenue, you're writing a check to the Georgia Heart Association, the Georgia Heart, which is the rural hospital group. It's an org that then takes that money, distributes it out to that hospital, and you're funding growth for that hospital in a rural area to make sure everybody has available health care in that area. So it's a way, instead of just sending your money to Georgia for them to decide what's going to happen to your tax dollars, you can actually send it to something specific. I know there's the education expense tax credit also here that helps with different scholarship organizations. I know a lot of that's been around for quite a while. It's usually capped at $2,500 for married filing joint, $1,000 for single filers. But now they also have come out with not just the rural hospital credit, but there's other credits out there for public service. I know the Kennesaw Public Safety Group here has a credit where you can contribute to them. So it's going into the fire and police stations here in your local area. So instead of writing a check to Georgia, they decide where your money goes. You can actually funnel that money somewhere specific. There's also the film tax credits here in Georgia. Those have been around for quite a while now with the boom of the film industry here, but you can actually buy credits. The rate of return on those have gotten smaller. You're talking about probably 7 or 8 cents on the dollar. So usually you got to have about 50,000 in liability to where it really starts making sense to go out and do that. From our perspective, that's usually what we look at. If somebody is paying 50,000 in taxes, maybe it's beneficial to go out and look at the film tax credits. But that's a way, instead of paying $10,000 to the government, you're paying $9,200 to a company, and then you get $10,000 worth of credits. So it saves you $800. But then you have to turn around and pay tax on that $800. So there is some tax complexities there, but that's also available here in Georgia. And then a great planning opportunity, especially as people retire before they get to RMD age, required minimum distributions. And I know we work together on this quite a bit with clients. Graham, is Roth conversions. So this is a great tool. I think, even though we don't have a crystal ball and we don't know what's going to happen, most people probably agree that where we are in the debt situation, that taxes are probably going to go up. They're not going to get any cheaper. So this is a way to try to take advantage of some of your lower tax bracket years in order to convert some of your taxable money in the future to non-taxable. So if you've retired and rolled over into an IRA, for your 401k retirement, went into an IRA, at your RMD age, when you hit that age right now, was it 63, you're required to start taking distributions?
73, yes.
So I'm sorry?
73.
77, I'm sorry, 73, yes. So when you hit 73, you're required to take money out. Well, we can look and see, based on assumptions, what's your tax impact going to be in that year when you have to take these lump sums out? Well, if you've retired and you've got, if you retired at 68 and you still got 5 years before you have to take those RMDs, you might have some of these smaller tax brackets, the 10, the 15, the 22% bracket, where we can utilize that. Go ahead and convert some of your IRA to Roth, pay a smaller tax amount, and you're shifting, again, wealth from your going to be taxable in the future to never taxable. So we can do analysis for that and kind of show different scenarios and conversions based on different assumptions. So great tool for trying to maximize after-tax net worth.
Hey, John, how important it is for everyone to be mindful of, or at least understanding what your marginal tax rate is, and how could they apply that?
Well, I think it's very important, especially when you look at these types of planning opportunities and deductions. I mean, just as simple a charitable contribution. I mean, some people think you give, that they're giving to charity for the tax deduction. Well, do you even know, are you itemizing? Are you actually getting a benefit? What is your effective rate? What's the benefit of that? It might be more beneficial to consolidate your contributions and give in 1 year for multiple years so that you're maximizing that return. Your effective rate could change based on income, bonuses. So it's very important, again, when we look at your after-tax net worth, because obviously we all work very hard and we want to pay the minimum amount of taxes, and ultimately that will maximize our after-tax net worth. I mean, if you're paying 37 cents on the dollar and you can cut it to 22, I mean, that's a great ROI, right? So it's hard to get that kind of ROI in the market, but those are great wins for clients.
Right. Thank you.
So then for businesses, shifting a little bit to business owners, that we also same concept. There's some different planning opportunities for business owners when we look at after-tax net worth. These are some of the tools we use when looking at clients, when trying to do planning opportunities. First one, retirement plans. I love retirement plans. Most people think when you spend $1, I'm saving taxes, but in reality, you're spending $1 to save 40 cents. So is it really a great strategy to spend $1 to save 40 cents? Well, with retirement savings, you're taking money out of your left pocket, you're putting it in your right pocket, and you're getting a tax deduction. So for me, it's the best tax planning strategy that there could possibly be, because again, it's your money, you're just shifting the buckets and you're taking a tax deduction. Now, again, you're taking a tax deduction, today's tax dollars, with the assumption that one day you're going to have to pay tax on it. We really don't know what that tax rate is going to be, but a lot of people like the idea of, hey, it's saving me money now. It can go into retirement, it can make money, and then we can come up with planning opportunities in the future when we get there. So these are some of the different plans we look at for clients. It just depends on the situation, how many employees they have and things like that, but great opportunities to, again, maximize your after-tax net worth.
Hey, John, if someone was in that higher tax bracket area and they can't do, or even if they could, well, let's say they couldn't do a Roth on the outside, right? And maybe because they already have an IRA on the outside, really the back door doesn't make a lot of sense that we talked about early on. A lot of these plans have Roth options, not just the traditional deductible option. How important it is for them to kind of weigh that out.
Very important, especially because the caps are a lot higher, right? With the Roth IRA, you're talking about a smaller cap. I mean, for your 401k, and so you're talking about $23,500 that you could potentially put in a Roth. Now, again, you're going to be subject to tax today, but if you feel like you're in a lower tax bracket today than you will be in the future, that's a great strategy to, again, maximize your after-tax net worth for one day. And a lot of these plans now, I mean, if you don't have those components, it's something to talk to your employer about. I know a lot of employers change their plans from requests from the employees. Even plans now have an ability to convert. You can convert your 401k. Well, if the plan allows it, you can actually convert your 401k. If you put tax deferred dollars in, and you for whatever reason, maybe the market declines 50%. Let's hope not, but if it does, and you want to convert it to Roth, you could go in and convert it to Roth. Now you're going to pay taxes on it based on today's tax rates, whatever your tax situation is. But then again, another great planning opportunity there from what you put aside in your retirement accounts. So,
thank you.
Probably one of the biggest, I think this comes back to organization for business clients when we're working with clients and trying to advise them on being tax efficient. A lot of times it comes back to record keeping and tracking your expenses. How many times business owners out and they pick up something for the business, but they pull out their personal card instead of their business card. The reimbursement of expenses is a great way to make sure to drop that tax rate, to drop your taxable income, because a lot of times there's just so many things that are missed. So you can actually set up different reimbursement plans within the business to document those, and therefore make it deductible and not pick it up as income. So if you reimburse expenses and you don't have an accountable plan, technically that becomes income to them. But if you have an accountable plan, then it becomes a deduction for the business. And it's pretty easy. I mean, most people, if anybody's ever filled out an expense report, that's an accountable plan. You're requiring your employees and you as an employee and sometimes the owner to fill out an expense report, give them a copy of the receipt, tell them what the business purpose is, to document that expense. But so many times businesses, I say, will overpay their taxes because they don't keep good records. So that's something we work a lot with clients. Income shifting. This is a great planning strategy, especially with the estate tax issue. We're always fluctuate back and forth of what the estate exemption is going to be. This is a great way to shift income from your high tax bracket to maybe family members' tax bracket, kids. It's something even I have 4 kids and it's something I do as from an income shifting standpoint. So it's able to take tax dollars that would be taxed at a higher rate, shift them to a lower rate. You also see family limited partnership set up, again, from an estate purposes. This is trying to shift those assets out of your estate to someone else's estate. So different planning opportunities here. Just again, we're trying to maximize after-tax net worth. The estate tax is a big part of that. Right now, you've got a large exclusion. So you're talking about 32 million, I think, for married couples. So it's a big number right now. But if that number ever comes down, or if your net worth is over that, 45% taxes is a big chunk. So just some things we look at, not just shifting income, but also shifting the estate for the estate tax. And then we'll try to get through these last couple real quick. State entity tax. This is something new in the last few years when they capped the state tax deduction on individual returns. So individuals are capped to $10,000 in taxes. So that includes your income tax, your property tax, and if you don't have income tax, you pay sales tax. Sales tax is included in there as well. So you can only deduct $10,000. Well, especially in these high tax states like New York and California, they pay a lot of taxes. So they were missing this deduction. So their effective rate went up, right? So if you had been deducting all these taxes on your tax return and now they took that deduction away, you're paying more taxes, but your income is the same. So your effective rate went up. Well, what a lot of states did was they came out with a state entity election where now business owners can pay their taxes at the entity level and take a deduction for it for federal. And if you're in a 37% bracket, guess what? You're getting a 37% ROI on that deduction because now you're deducting it for federal taxes. So your taxes are being decreased again. So when this didn't, it allowed that effective rate to come back down. So you have to file with the state, you make the election, you pay the taxes through your business, and you take the deduction for it. So it's a great planning opportunity that still is fairly new, that sometimes with new clients coming in, they haven't taken advantage of this before. So it's a great opportunity there. Bonus depreciation. This is something actually it was just announced the other day. They're trying to get back to 100%. It's one of those top level agenda items. They're talking about the R&D credit for business owners. They're talking about the bonus depreciation. There's a couple of things that businesses that they're trying to get through because there's such a benefit to not just the economy, but to business owners. If you want to invest in your business, it's nice to get immediate benefit from a tax perspective. So bonus depreciation is a way to allow you write off that asset at an accelerated amount. So normally if you go out and buy furnitures and fixtures, you have to depreciate them over 5 to 7 years. Well, With bonus depreciation, you could write them all off in 1 year. States don't usually allow bonus, so there is some differences with state, but it's from a planning perspective, things we look at. Do we want to take bonus? Do we want to use what's called Section 179 to make sure, because states allow 179, but it's a way to invest in your business, especially at year end, right? Everybody's looking at their tax bill at the year end and be like, what can I do to drive my tax liability down? Well, if there's things you need to invest in the business, better to go ahead and do it in December and get the tax benefit in December than incur it January, February, March, and you have to wait basically a whole year before you recognize that tax benefit. So it's usually really important at year end, trying to get in, these capital expenditures to take advantage of bonus. Right now, 2025, the bonus depreciation percentage is 40%. Not great. Again, 179 is another alternative to allow you write it off, but hopefully, we'll see Congress come through and make it retroactive to where hopefully by the end of the year, we'll have 100% bonus depreciation in place. Let's just keep our fingers crossed.
Thank you, John. I know you covered a ton of information in a short amount of time, and just want to remind everyone, tax planning is a part of an efficient wealth management plan. It is your legal obligation, often joke, but not really. It's your legal obligation to pay less taxes, and partnering with the right team, like John and his team, from the prep and filing aspect all the way to working with us and our tax planning steps that we take, using some pretty advanced software to baseline your previous year's tax returns, and then we can build scenarios out over time. Why not keep more of what you worked hard for? It's a part of that wealth management plan. Jeremy, if we got a minute or two, do you want to try to answer some questions?
Yeah, sorry, we're running a little long there, but we got a couple questions that did come in. For Graham, for you, what is some ongoing tax strategies that maybe we should be considering throughout the year inside taxable accounts?
Yeah, I think John really hit and we kind of chatted a bit when we were talking about the individual, but I kind of going back to what I originally, question I had for John is just positioning of assets can be huge, right? So if we think about all these little things that John mentioned that add up, and that's 100% correct statement, that little things do add up. And if you're talking about positioning of assets, and we're in a high tax bracket, peak earning years, pre and in right before retirement, which you probably are, maybe those investments, money markets, treasuries, things like that, which can make sense. Maybe they're better positioned in tax deferred accounts, so you keep a higher real return. Maybe municipals or individual stocks, indexing ETFs that are very tax efficient. Maybe they're better in your taxable accounts, less in your tax deferred. Doesn't mean they don't have a place in the other accounts. It's just little things add up to a lot, I guess, is the moral to the story here.
Gotcha. Well, John, I got a question for you. So with what's going on in Washington, should you file an extension if they do away with the IRS and some income taxes?
Well, I don't think they're going to do away with the IRS and income taxes. I think, as far as filing an extension, it really comes down to, do you have all your information necessary to file a timely filed return? And an extension does not extend your time to pay. So even though, you're filing an extension to file, that doesn't extend your time to pay. And in most cases, you got to sit down and do the work to figure out what you owe. So, unless you go through that whole process and you're waiting on one piece of information, it's usually more efficient to go ahead and file. But no, I don't think they're going to do away with the IRS or taxes anytime soon.
Okay. And then we had a question come in from one of our listeners. If you're sitting on a large portfolio, the best way to start reducing that balance without getting hit with a large tax bill?
Well, this might be a question for John and I. Consider gifting, right? John, could that be a method of starting to get it out of your estate if that's where we're going? Gifting, using tax laws, tax losses to offset gains in a portfolio, something that we do every year. John, I know we chat about it quite a bit. Let's look at our losers inside the portfolio, and not that we might not like them, but let's sell those losers to offset the winners. that we already have from a realized standpoint, or if we need to kind of lower exposure because some positions in our account have done quite well. Also, we can carry that forward for losses going forward and maybe lower income a little. So I think there's a lot of things that you can do inside of a taxable portfolio, large or small, just to mitigate some taxes along the way.
Yeah, and I'd say, a lot of times if you've got charitable inclinations, again, you can gift the high appreciated stock, so you're getting fair market value contribution, and then you're passing that tax to the charity, and they don't pay tax, right? So if you've got a big position and you have a charitable inclination, a lot of people use donor advised funds, so you're actually funding it now and getting the deduction now, but that money can be given to charities over a number of years. So if you're looking at taking large gains, sometimes combining that with gifting of stocks and to a donor advised fund or things like that, there's some planning opportunities to get, and it's always comes down to planning. It's part of the plan, right? If clients have a financial plan and they have and everybody's on the same page, it's executing that plan and coming up with these strategies to minimize their taxes and, again, maximize their after-tax net worth. So it all becomes part of that team effort and trying to execute the plan to achieve what the client's trying to achieve.
Right. Jeremy, if I can add one thing to that, what about QCDs, qualified charitable distributions, John? What role could they play?
Oh, yeah, definitely. If you've got distributions you have to take from a tax deferred account or an IRA, QCDs allows you to give it directly to a charity, and it's not income. So if you have a $50,000 IRA distribution, required minimum distribution, you could give that money directly to a charity, and now that $50,000 is not income. You can't deduct it as an itemized deduction, so we got to remember, if you itemize, it's not increasing your ability to itemize. It's a straight out reduction of your income from that IRA. So, but yeah, QCDs are a great planning tool. Again, clients have a charitable inclination, great planning tool for helping execute that part of the plan.
Awesome. Is there an age limit for that? For the QCD?
I believe it's
half kind of sticks out in my mind. So.
Yeah, I was thinking 65, somewhere around there. I mean, it's before RMDs.
Right. So it'd be before 73.
Yeah.
RMD requirement age. Yeah. Okay. No, thank you, John.
Well, gentlemen, I think that's all the questions we had. Thank you, John. Thank you, Graham, for y'all's information and expertise. And thank you to our listeners that were registered for the webinar. And we really appreciate it. And be looking for the next one coming up at the second quarter. And we'll be having a whole nother topic for you. And we look forward to seeing you next time.
Thank you.
Thank you.